Okay guys, let's do an example where there's unrealized profit in the question. Beulah Trading is an entity with a 30 June year end. The entity manufactures school shoes, and you will see it's exorbitant prices, but nevertheless, it must be walking on air, something on water, I don't know. Shoes that are manufactured by Beulah Trading are transferred to the sales department at a markup cost of 30% on cost. So what does that mean? It means once it leaves the factory environment and it is transferred to the sales department, then there's an unrealized profit component added to the actual cost of manufacturing of 30% by the factory environment. The following costs were recorded in the books of Beulah for the year ended 30 June 2014. Okay, and then they give us a lot of information, and what do they require from us? They say prepare the following general ledger accounts: raw materials, work in progress, finished goods, and allowance for unrealized profit. And this one, the allowance account for unrealized profit, that is a statement of financial position account. And then there's another unrealized profit account. That other account is a statement of profit or loss account. Good. And that is the account, the other one, that you're going to close off against cost of sales at the end of the year. This allowance for unrealized profit is the account balance that you're going to subtract from your inventory finished goods balance at year end in order to derive at the final figure, the actual cost price figure of your inventory, as you will disclose it in your statement of financial position. Okay, ignore that. Good. Now let's start. First place, let's open up all the T accounts: a raw material account, a work in progress, a finished goods, allowance for unrealized profit account. Raw materials inventory on 1 July 2013, opening balance 45,000 Rand. So my raw material account, there's my opening balance, 45,000 Rand. Then we have purchased raw material of 156,400, so it's still in our raw materials account, bank or creditors, depending on where we have paid it, 156,400. That has increased our raw material account for the year. Then labour cost was 89,000 Rand. Now, usually you're going to book it to direct labour account. They don't ask you a direct labour account, but at the end of the day, you're going to close off your direct labour account against your work in progress account. So here's our labour cost for the year, 89,000 Rand. Raw materials inventory at the end of the year, 67,900. So we have the closing balance, 67,900, and therefore we can work out our balancing figure. And what is our balancing figure? The raw material issued to the factory environment. So that goes to work in process. That's our balancing figure, 133,500. Work in progress then, 133,500. Guys, please note that my purchases amount does not go to work in progress. What goes to work in progress is the amount of direct material issued, which I work out here as the balancing figure of 133,500. There's the debit entry, there's the credit entry, and the thing balances. You must always, for everything that you do in accounting, think about what was the debit, what was the credit. Right, depreciation. We know that depreciation is an overhead cost, 4,500 Rand. So we're going to post it to overheads, depreciation, 4,500 Rand. Power and water consumption, 7,500. That is also overheads. Power, 7,500. And then insurance, also overhead cost of 2,350. Then a maintenance, 749, also overhead cost, 749. Good. Then selling and general admin costs. Now that's got absolutely nothing to do with my production costs, so I just ignore that. That is a normal operating expense in my income statement. Work in progress as at 1 July, so that was incompleted products at the beginning of the year, 15,000. So in my work in progress account, opening balance 15,000, and then work in progress at the end of the year 9,300. So closing balance then 9,300. They give us, they say the records of the sales department showed the following. Now, the sales department only works with finished goods. So this is my finished goods inventory. As at the beginning of the year, 167,000, and my closing finished goods inventory 68,000 at the end of the year. So finished goods, opening balance 167, closing balance 68,000. Right, and that is all the information of the question, except that 1,500 pairs of shoes with a selling price of 460,000 Rand were sold during the year by the sales department. So let's complete the picture and work out the cost of goods manufactured for the year. Right, our raw materials, we've already done that. We've already closed it off, and we've already determined that the material issued was 133,500. Overheads, we can now close off our overhead account. We're going to accumulate all those costs. The total of all that cost, 15,099. We're going to credit overheads. We're going to debit work in progress, 15,099. We have the opening balance and closing balance here. So now we can determine what was the actual cost of goods manufactured, which is the balancing figure in the work in progress account on the credit side, 243,299. But can you see this is actual cost, actual cost, actual. So work in progress always have my actual cost of manufacturing. We can also now work out what is our total cost of manufacturing. If the total cost of manufacturing was 243,299, and we have determined what is going to be the number of items which we did manufacture during the year, which will equal, they give us the information, they said we had 150 pairs at the beginning of the year, then we have increased our stock levels with the number of pairs that we've manufactured, we have sold minus 1,500 pairs equals the 80 pairs that we still have on hand at the end of the year. So our balancing figure, we had 150, we've manufactured, we're going to work it out, we've sold 1,500, that equals 80, so that means we've manufactured 1,430. Number of pairs of shoes during the year. If you want to work out, it's not required in this question, but you will see sometimes in a lot of questions you have to work it out in order to get a price per unit. But in this question, if we should have worked it out, it would have been our total manufacturing cost, 243,299, divided by the number of the pairs of shoes that we've manufactured, 1,430, and that gives us a manufacturing cost of 170,040. Now, once we've completed the work in progress account, that is where the involvement of the factory stops. They're going to transfer these goods now to the sales department. Now, you can see that I can only transfer the actual cost out of the work in progress account. So if you go to finished goods, we already spoken about the opening balance and the closing balance. Here you see out of the work in progress account, 243,299. But remember, the factory environment transfers all this stock to the sales department at a markup of 30% on the cost. So although I can only transfer from my work in progress accounting-wise, the total amount, the actual amount of the cost manufactured, of the goods manufactured, 243,299, we have to bump it up with a 30% because the sales department is going to receive these pairs, 1,430 pairs, at a bumped up price. Now, what is the bumped up price? Well, they're going to add 30% to the cost, and that is the cost. So 30% of the 243,299 gives us 72,990. So the amount that they will see as the cost price of these 1,430 pairs will be those two figures together. Now, obviously, if you're going to pass a debit entry in this account, where does the credit entry goes to? Guys, in this credit entry goes to our unrealized profit P&L account. Just merge this so that we don't have. There you are. So, not our allowance for unrealized profit account. That is completely a different account, which I'm going to talk about now. That 72,990 is going to go to the unrealized profit and loss account. So here's our unrealized profit and loss account. Out of our finished goods, there is actually the 72,990. that is finished goods, the amount at which, or the bumped up portion of the amount at which they have transferred these things or these pairs to 72990 to the sales department from the factory environment. So this is the debit entry, and then this one there is the credit entry of that transaction. Right, coming back to our finished goods. We've already established that once the item reaches the sales department, it reaches the sales department with a bumped up price. Included in that cost price will be a 30% unrealized profit amount as well. So that means included in my opening inventory of 167,000 was a 30% unrealized profit element. And that we took out in our allowance for unrealized profit account. So what was the unrealized profit included there? That was 167,000 times 30 divided by 130, and that gives us 38,538. So our opening balance, that you can always work out if I give you the value of my opening inventory and I tell you what is the unrealized profit percentage, you must by yourself know how to work out the opening balance on the allowance for unrealized profit. So last year in our financial statements, inventory was shown at 167,000 less 38,538. Only the net amount would have been shown. Good. Now the next one then is in our closing balance. Now before we get to the closing balance, which we have already posted, they gave it to us, 68,000 Rand. Inventory at the end of the year, 68,000 Rand. We must also know that there's an unrealized profit component included in the 68,000 Rand. Now we have a choice. We can either argue that this 38,538, it is actually exactly the same thing, it's just the way that we're going to record it that's different, is the unrealized profit in our opening inventory. So we can say, and that's true, we have sold that inventory during the course of the year. So I could have then taken out the 38,538 out of this account to clean it up and then transfer that 38,538 to our unrealized profit and loss account, 38,538. Then we could have said, well, in our closing inventory, there's also going to be unrealized profit. So 68,000 times 30 divided by 130, that gives us 15,692. So that is what we want the closing balance to be on our allowance for unrealized profit. So if we go back to the previous one, what we have done here is we've taken out the full 38,538. So there's nothing left. So if we want a closing balance of 15,692, we would have credited this account with 15,692 and we would have debited this account with 15,692. What is the net impact of these two entries? Can you see that there's a net credit here of 22,846? Now what they've done in this question, and they do it in a lot of your memos, they only post the movement on the allowance for unrealized profit account to my unrealized P&L account. So here you can see, in order to make this thing balance, I want a closing balance of 15,692. So if I just left my opening balance there of 38,538, and I want to change that opening balance to a closing balance of 15,692, I need a debit on this account of 22,846. And I would have posted that credit side of that entry to my unrealized profit P&L account, 22,846. But can you see you achieve exactly the same thing either way? If I've taken out the opening balance, and I took it directly to the credit side of our unrealized profit and loss account, and then I said, well, now my allowance account is 0, and at the end of the day I want to create a balance of 15,000, so I've put 15,000 on the credit side and the debit side here, 5692. The net impact would have been the net credit of 22,846. If I didn't go the long route and I said, well, let's just have a look what is the amount that we have to change in our allowance for unrealized profit account in order to record our unrealized profit in our closing inventory figure. We said, well, we're going to need a debit here of 22,846. Remember, we didn't remove the 38,000. We want the 38,000 now to become 15,000. Therefore, we're going to need a 22,000, and that would have been a net credit there of 22,000. Right. So, coming back here, what is going to be then cost of sales? Now, cost of sales is going to be the balancing figure in my finished goods account, 415,289. So I'm going to credit my finished goods 415,289, and I'm going to debit my cost of sales 415,289. And then I'm done with finished goods. My allowance for unrealized profit is being pumped up, so I'm happy with that one. Coming back to this one, our unrealized profit P&L account, we now have those two entries. We have that entry, remember that is the unrealized profit for the goods manufactured in the current year, the 72,990, there's English, 72,990. Right, that one, 22,846, is that 22,846? That one was not posted there, so actually I must just move it a little bit to this side. It's not included in that total there. So there was only the net of 22,846 posted in the accounts, in the totals there. So I'm done with the unrealized P&L account. And if I'm going to balance this off, the balancing figure is the figure that I'm going to get on the debit side. And that balancing figure of 95,836, I'm going to post to my cost of sales account. And that was the unrealized profit included in my cost of sales for the period. Remember, what did I post to my cost of sales account up till now? I've posted that one 415,289. From which account? From the finished goods account. What is lying in the finished goods account? My bumped up amounts. So all these amounts in the finished goods account include the 30% unrealized profit. So my cost of sales, I have to adjust because that thing is inflated as it's lying there with 30%. By posting this amount to cost of sales, now what is this amount? Let's go and check. This amount is the unrealized profit in opening inventory, the unrealized profit in goods manufactured for the year, less the unrealized profit in closing inventory. And what is it? Opening inventory, manufactured, minus closing inventory, cost of sales. So that balancing figure of 95,836 is our unrealized portion included in our cost of sales amount of 415,289. So I'm going to transfer our credit, we're going to debit our unrealized P&L account, we're going to credit our cost of sales account with a 95,836. The amount that we're going to transfer then to our trading account is going to be our actual cost of sales for the year without any unrealized profit figures included. They've told us that the sales for the year was 460,000 Rand. So at the end of the year, we're going to close off our sales account against our trading account. There it is sales. Cost of sales is now going to be the 319,453, and our actual gross profit for the year is going to be 140,547, which is going to be transferred to our profit and loss account.